You know that sick feeling in your stomach when you watch your position drop 15% and you can't bring yourself to close it? That's not the market talking. That's you, staring directly at your own psychological blueprint. Trading doesn't just move money around. It drags every fear, every insecurity, every pattern you've spent years avoiding straight into the light. And here's the uncomfortable truth. The charts aren't lying to you, but you're definitely lying to yourself. Most people think trading is about predicting market movements, reading technical indicators, or finding the perfect entry point. They spend thousands of hours analyzing candlestick patterns and Fibonacci retracements, convinced that the secret is hidden somewhere in the data. But professional traders will tell you something completely different. The real battle happens in the 6 inches between your ears, and most people lose before they even place their first trade. Your trading account is essentially a psychological X-ray machine, revealing patterns in your decision-making that show up everywhere else in your life. That impulsive trade you just made, it's the same energy that makes you buy things you don't need when you're feeling stressed. That loss you're refusing to accept, it's connected to the same defense mechanisms that stop you from admitting mistakes at work or in relationships. Research from behavioral economists shows that humans are hardwired with cognitive biases that made sense when we were avoiding predators on the savannah but destroy our portfolios in modern markets. Loss aversion is real and measurable. Studies demonstrate that the psychological pain of losing money is approximately 2.5 times more intense than the pleasure of gaining the same amount. This isn't just a preference, it's a fundamental asymmetry in how our brains process risk. When you're up $100, you feel pretty good. When you're down $100, it feels like someone punched you in the chest. This imbalance causes traders to hold losing positions far too long, hoping for a reversal, while cutting winning positions too early to lock in that dopamine hit of realized gains. The confirmation bias trap catches almost everyone at some point. You decide a stock is going up, so you suddenly notice every piece of positive news about that company while completely dismissing contradicting information. Your brain becomes a filter that only lets through data supporting your existing position. Traders will scroll past 5 articles explaining why their trade might fail and focus entirely on the one analyst who agrees with them. This selective attention creates an echo chamber inside your own mind. You're not analyzing the market anymore. You're defending your ego's need to be right. Psychology researchers have documented this phenomenon across thousands of studies. Once humans form a belief, they unconsciously seek evidence that confirms it while avoiding or discounting evidence that challenges it. In trading, this bias doesn't just cost you accuracy, it costs you real money. Overconfidence might be the most expensive personality trait in financial markets. After a few winning trades, something shifts in your brain chemistry. You start believing you've cracked the code. The wins feel like confirmation of your superior skill rather than what they often are. Luck combined with favorable market conditions. Studies of trader performance consistently show that overconfident traders take larger positions, trade more frequently, and ultimately underperform more cautious traders. They mistake a bull market for genius. They attribute successes to their brilliant analysis while blaming losses on external factors like manipulation or bad luck. This attribution error creates a dangerous feedback loop. Wins inflate your ego while losses teach you nothing because you've externalized the blame. Professional poker players understand this better than most traders. They know that short-term results are heavily influenced by variance, and they focus on process rather than outcomes. A good decision that leads to a loss is still a good decision. A bad decision that happens to make money is still a bad decision. Your relationship with money gets exposed in trading faster than any therapy session ever could. If you grew up in scarcity, watching every dollar, you might be paralyzed by fear when it's time to pull the trigger on a position. If money came easily in your background, you might treat trading like a casino, not respecting the reality that this is your actual capital at risk. Some traders unconsciously sabotage themselves when they get close to significant profits because deep down they don't believe they deserve wealth. Others revenge trade after a loss, desperately trying to recover immediately, which is emotionally identical to chasing a romantic partner who just rejected you. The underlying psychology is the same. Your ego can't handle the rejection, so you make increasingly desperate attempts to prove your worth. The planning fallacy shows up constantly in trading journals. You'll spend hours creating a detailed trade plan with clear entry points, stop losses, and profit targets. Then the market opens, and within minutes, you've abandoned everything you wrote. Why does this happen? Because the version of you that made the plan was calm and rational, while the version of you executing the trade is flooded with neurochemicals, operating under stress, watching real money fluctuate. These are essentially two different people. The planner is your prefrontal cortex doing its job. The executor is your limbic system in survival mode. Unless you've done serious work to bridge that gap, your plans are just wishes written written on paper. Experienced traders build systems specifically designed to protect them from their own impulses. They use hard stops programmed into their platform so emotion can't override the decision. They limit their position sizes to amounts that won't trigger panic if the trade moves against them. They're not smarter, they've just accepted that they can't trust their in-the-moment decision-making. Recency bias makes traders give disproportionate weight to recent events. The market crashed yesterday, so you become convinced it'll crash again today, even though historically this correlation is weak. You had 3 losing trades in a row, so you're certain the 4th will also lose, causing you to skip a genuinely good setup. Your brain treats recent memories as more statistically significant than they actually are. This is a survival mechanism from our evolutionary past where remembering the location of yesterday's predator was more useful than remembering last year's. But markets don't work on predator logic. A stock that dropped 20% yesterday has no memory of that event and no obligation to continue the pattern. Probability doesn't care about your recent experience. Each setup should be evaluated on its own merits, but our brains aren't built to think this way naturally. The endowment effect causes you to overvalue things simply because you own them. Once you've entered a position, it becomes yours, and your brain immediately assigns it more value than identical positions you don't own. This is why traders hold losing stocks they would never buy at current prices. If you own a stock at $50 and it drops to $30, ask yourself honestly, if you had cash right now and no position, would you buy that stock at $30? If the answer is no, you're only holding it because of the endowment effect. You're attached to your original decision rather than evaluating current reality. Professional traders learn to think in terms of opportunity cost. Every dollar in a bad position is a dollar not available for a good position. They become ruthless about cutting attachments to losing trades because they understand that capital preservation is the foundation of long-term success. Anchoring bias locks your perception to irrelevant numbers. You bought a stock at $100, so your brain anchors to that price. When it drops to $80, you can't see it objectively. You're not evaluating whether $80 represents good value based on current information. You're just comparing it to your anchor of $100 and feeling like it's cheap now. This is completely illogical. The market doesn't care what you paid. The only relevant question is, based on everything known right now, is this asset likely to increase in value from its current price? Your entry point is emotionally significant to you, but financially meaningless to the market. Traders who overcome anchoring bias can admit mistakes quickly and redeploy capital to better opportunities without the emotional baggage of their original entry price. The disposition effect is the tendency to sell winners too early and hold losers too long. It's directly connected to how our brains process regret and pride. Selling a winner gives you the certainty of a realized gain and the pride of being right. Holding a loser keeps alive the possibility that you might avoid the regret of admitting you were wrong. Research tracking thousands of brokerage accounts shows this pattern repeatedly. Traders consistently realize gains at a much higher rate than losses, which is exactly backwards from what profitable trading requires. The correct approach is to let winners run and cut losers quickly, but this approach feels terrible emotionally. It means admitting mistakes often and waiting patiently during the psychologically difficult period when a winning trade pulls back temporarily. Most people can't handle the emotional discomfort, so they optimize for feeling good rather than making money. Social proof bias makes you want to follow the crowd, especially when you're uncertain. You see everyone on social media buying a particular stock and you feel foolish sitting on the sidelines. This fear of missing out isn't about the stock's fundamentals. It's about your need for social validation and your fear of being left behind. By the time a trade idea has spread across social media to the point where everyone's talking about it, the easy money has usually already been made. You're not getting in early, you're providing exit liquidity for smarter traders who position themselves before the hype. Contrarian traders specifically look for moments when crowd sentiment reaches extremes because they understand that markets are driven by supply and demand. And when everyone who wants to buy is already bought, there's only one direction left for price to move. Your trading reveals your relationship with discipline in ways that most other activities don't. Going to the gym requires discipline, but if you skip a workout, the consequence is just missing one workout. In trading, one undisciplined decision can wipe out weeks or months of careful gains. The market is an unforgiving teacher that charges tuition in real dollars every time you break your own rules. Some people discover through trading that they have essentially no self-discipline when money and emotion are involved. They can follow a diet plan or stick to a study schedule, but put them in front of live charts with their capital at risk, and they become completely different people. This isn't a moral failing. It's valuable information about where you need to build systems and safeguards. Hindsight bias makes you believe you knew what was going to happen after it's already happened. The market makes a big move, and suddenly you remember thinking it might do exactly that, even though your your actual trade was in the opposite direction. Your brain retroactively edits your memories to make you feel like you had better foresight than you actually did. This bias prevents learning, because if you believe you already knew what was going to happen, you don't analyze what you actually missed. Keeping a detailed trading journal with time-stamped entries about your reasoning before the trade is the only way to combat this. When you can read your actual thoughts from before the event, you can't trick yourself with edited memories. The gambler's fallacy convinces you that past random events influence future probabilities. You've had 5 losing trades, so you feel like you're due for a winner. Or you've had 5 winners, so you're convinced the next one must be a loser. This is magical thinking applied to markets. Each trade is an independent event with its own probability based on current conditions. The universe isn't keeping score and balancing things out for you. Understanding this intellectually is easy. Actually feeling it when you're on a losing streak and desperate for a win is nearly impossible. This is where many traders blow up their accounts, doubling position sizes because they feel like they're owed a winning trade after a series of losses. Fear of regret causes you to avoid taking action even when your analysis says you should. You don't enter the trade because you're afraid of the regret you'll feel if it doesn't work out. Then, the trade moves exactly as you predicted, and you experience a different kind of regret for not participating. Either way, you lose, but at least if you'd taken the trade according to your analysis, you'd have data to learn from. Regret from inaction is often more painful than regret from action, because inaction is entirely on you. There's no market movement to blame, just your own paralysis. Trading will show you whether you're able to think probabilistically or whether you need certainty. Markets deal in probabilities, not certainties. A trade with 60% win rate is excellent, but it means you're going to lose 40% of the time. Can you execute a strategy knowing that 4 out of every 10 trades will fail? Most people can't. They need to be right more often than that for their ego to handle it. Professional traders are comfortable being wrong frequently as long as their wins are larger than their losses and their overall expectancy is positive. This requires a fundamental shift in how you define success. Success isn't being right on any individual trade. Success is following your process consistently and letting probability work over a large sample size. The spotlight effect makes you think everyone is watching and judging your trades. You're afraid to admit you lost money because you imagine everyone will think you're stupid. In reality, everyone else is too busy worrying about their own positions to care about yours. This imaginary audience prevents honest discussions about losses and mistakes, which means you can't learn from other people's experiences. Trading communities that normalize discussing failures and mistakes are far more valuable than those where everyone only posts their winning trades. The wins teach you nothing except that the person got lucky or executed well. The losses contain the actual lessons if people are honest about what went wrong. Your trading will reveal whether you can separate your self-worth from your results. If your identity is tied to being a successful trader, every losing trade becomes a personal attack on your value as a human being. This makes it nearly impossible to admit mistakes, cut losses, or learn from failures. Your ego has too much invested in being right. Traders who maintain emotional stability separate their identity from their results. They see trading as a skill they're developing, not a measure of their worth. They can take a loss, analyze what happened, adjust if necessary, and move on without the emotional devastation that comes from tying their self-esteem to their win rate. The market doesn't care about your bills, your goals, or your timeline. It moves based on supply and demand, driven by millions of participants with different time horizons and objectives. When you approach trading with desperation, needing to make a certain amount by a certain date, you've already lost. Desperation causes you to see setups that aren't there, take excessive risk, and abandon your process. The market can sense desperation the way predators can sense fear. Traders operating from abundance and patience have a massive advantage over those operating from scarcity and urgency. They can wait for genuine A-grade setups instead of forcing B and C-grade trades because they need to make something happen. Trading is ultimately about pattern recognition applied to both markets and yourself. The charts show patterns of price movement. Your trading journal shows patterns in your decision-making. Most traders obsess over the first kind while ignoring the second, but the most expensive patterns are usually the psychological ones. You might recognize a head and shoulders pattern every single time it appears on a chart, but if you don't recognize your pattern of revenge trading after losses, the technical analysis skills won't save you. Self-awareness isn't a nice-to-have in trading, it's fundamental to survival. The traders who last long enough to become consistently profitable are the ones who got ruthlessly honest about their psychological patterns and built systems to protect themselves from their own worst impulses. The market will keep teaching you about yourself whether you want to learn or not. The only question is whether you'll pay attention to the lessons or keep paying tuition on the same mistakes repeatedly.